2024 is poised to be a pivotal year in global politics, with major elections set to reshape the geopolitical landscape. The United States, the European Union, and India, representing diverse economic powerhouses, will hold elections, each carrying significant weight in shaping global trade, alliances, and economic policies. The outcomes of these elections have the potential to trigger significant shifts in global markets. Uncertainty reigns as investors and businesses alike brace for potential policy changes, trade disputes, and economic reforms. These elections arrive at a time of already heightened geopolitical tension. The ongoing conflict in Ukraine, rising inflation, and supply chain disruptions have contributed to a sense of global unease. Policy decisions made by the incoming administrations will have far-reaching consequences, influencing everything from energy prices to international relations. In this climate of uncertainty, investors often seek safe haven assets, and historically, gold has played that role remarkably well. Elections, by their very nature, introduce an element of uncertainty into the global economy. Markets, much like people, dislike uncertainty. The possibility of new administrations with different economic agendas can lead to market volatility as investors adjust their portfolios in anticipation of potential policy changes. Tax reforms, trade agreements, and regulatory shifts can all impact corporate profits, currency valuations, and overall market sentiment. History offers numerous examples of elections impacting markets. In 1980, the election of Ronald Reagan in the United States coincided with a surge in the stock market fueled by expectations of tax cuts and deregulation. Conversely, the 2016 Brexit referendum in the United Kingdom sent shockwaves through global markets as the value of the British pound plummeted amidst uncertainty surrounding the UK's future relationship with the European Union. In times of economic and political turmoil, investors often turn to safe haven assets that are expected to retain or even increase in value during periods of market stress. Gold, throughout history, has held a unique position as a safe haven asset, often appreciating in value when other assets, like stocks or bonds, decline. This inverse correlation between gold and riskier assets is part of what makes it attractive during periods of uncertainty, such as elections. Several factors contribute to gold's safe haven status. First, gold is a tangible asset with intrinsic value. Unlike fiat currencies, which are backed by governments, gold cannot be simply printed or devalued by central bank policies, making it a hedge against inflation. Second, gold has a long history as a store of value, dating back centuries. This historical precedent reinforces its psychological appeal as a safe haven during times of crisis. While gold often steals the spotlight, other precious metals also play a role in times of uncertainty. Silver, platinum, and palladium, often referred to as industrial metals, are used in various industrial applications from electronics to automotive manufacturing. Their demand is often linked to economic growth. However, they too can benefit from safe haven demand during periods of geopolitical instability. Investors seeking to diversify their portfolios beyond traditional stocks and bonds often consider precious metals as a way to hedge against inflation, economic downturns, or geopolitical risks. The 2024 elections, with their potential to reshape the global landscape, could further fuel interest in precious metals as investors seek to protect their wealth amidst uncertainty. Investing during times of political and economic uncertainty requires careful consideration and a long-term perspective. While precious metals can offer a hedge against certain risks, it's essential to remember that no investment is entirely risk-free. Market fluctuations are inevitable, and past performance is not always indicative of future results. Diversification remains key. A well-diversified investment portfolio should include a mix of assets, including stocks, bonds, real estate, and potentially a portion allocated to precious metals. The specific allocation to precious metals should align with an individual's risk tolerance, investment goals, and overall financial plan. Consulting with a qualified financial advisor can provide valuable insights tailored to individual circumstances. The UK, like many countries, levies taxes on capital gains, profits realised from the sale of assets, including precious metals. Understanding the tax implications of investing in precious metals is crucial for UK investors. The UK's capital gains tax, or CGT, applies to profits made from selling precious metals, but there are exemptions and allowances to consider. For the 2023 to 2024 tax year, the UK's CGT allowance is £12,300. This means that individuals can realise up to £12,300 in capital gains before any CGT is due. Profits exceeding this allowance are taxed at either 10% or 20%. Depending on the individual's income tax bracket. However, it's important to note that investments held within an individual savings account, or ISA, are exempt from CGT, making ISAs a tax-efficient way to invest in precious metals. Examining past election cycles reveals a mixed bag of market reactions. In some instances, markets have rallied on the back of pro-business policies or increased certainty following an election. In other cases, uncertainty surrounding new administrations or unexpected election outcomes has triggered market volatility. For example, the 2008 US presidential election, occurring during the global financial crisis, saw a sharp market decline regardless of the outcome. The key takeaway is that elections often act as a catalyst for market movements, but they are rarely the sole driver. Economic indicators, geopolitical events, and investor sentiment all play a role in shaping market trends. Understanding these interconnected factors is essential for navigating the complexities of investing during election years. Looking ahead, the role of precious metals in a world grappling with geopolitical uncertainty, inflation, and potential economic slowdowns remains a topic of much debate. Some analysts predict a continued surge in demand for safe haven assets like gold, driven by fears of recession, currency devaluation, and escalating geopolitical tensions. Others argue that the global economic landscape is evolving, with factors such as the rise of digital currencies and renewable energy technologies potentially impacting the long-term demand for precious metals. While the future remains uncertain, one thing is clear: precious metals, with their historical significance and unique properties, are likely to remain an integral part of the global financial system for years to come. As we navigate the uncertainties of 2024 and beyond, prudence and careful planning are paramount. The global economy stands at a crossroads, influenced by elections, geopolitical shifts, and evolving technologies. Investors seeking to protect and grow their wealth must carefully consider the potential risks and rewards of various asset classes, including precious metals. Precious metals, with their historical allure as safe haven assets and their potential to hedge against inflation, offer a compelling addition to a well-diversified portfolio. However, it's crucial to remember that no investment is without risk. Thorough research, an understanding of the tax implications, and a long-term perspective are essential for navigating the complexities of investing in precious metals, especially during times of uncertainty.